Alright, so how do we make these adjusting entries? Well, we're going to use a three-step method along with using our tabular analysis, which is again our big old table. So step one, we're going to determine the current account balances. Okay. And for this course, we will use that unadjusted summary of transactions, which basically make up what is known as an unadjusted trial balance. But for this class, it is just a summary of transactions, not too bad. Step two, we'll determine what the current account balance should be at the end of the period. If there is no difference between step one and step two, then of course there is no adjustment. But we wouldn't have this chapter if that was always the case. So otherwise, we're going to go ahead and move on to step three. Step three, we're going to record an adjusting entry to adjust the account balances to what it should be. And this is usually determine which accounts are needed and analyzing the impact on the account equation, which we can see with our table, and determine the accounts that are affected and record. So with this, we do have a nice set of cheat codes because y'all know I'm a gamer, and gamers, sometimes we love just to enhance our playing experience. We bring in some cheat codes. So for adjusting entries, these again are our nice little cheat codes. First off, every adjusted entry will affect at least one income statement account and one balance sheet account. So this basically means we're going to affect either a revenue or expense, and we're either going to affect an asset or a liability. Okay. Two, cash will never be affected by an adjusted entry. We will not adjust cash ever. The only time we ever adjust cash is if there was an error that was made, and that will be in a bank reconciliation before this period. Okay, so cash is never used for us. All adjusting entries do occur at the end of the accounting period. So we do all of our journal entries, and we then hit the adjusting period. So usually their dates are always at the end if we actually dated our transactions. So here is using the example from the book and us going through the 11 transactions that we already had. In fact, the rest of this chapter is going to be using this. As you can see already, we have our balances. We're using cash, supplies, prepaids, equipment, notes payable, accounts payable, unearned, common stock, revenue, expense, and dividends. We also have this last column that tells you what revenue and expenses that we're using. So when we make the income statement, we can. So first one of the group of four was deferred expenses. And again, these were assets that were basically prepaids. So they're going to benefit more than one accounting period. And the issue usually is to recognize any benefits that were realized in the current or previous accounting periods that was not yet recorded. Okay. Again, we haven't recorded the amount that we have used. And it usually requires a calculation. We're going to go over it as we can. And of course, prior to this adjustment, usually if we don't adjust, our assets are definitely going to be overstated and our expenses will be understated. So as you can see, for a prepaid, to make our adjustment, we're going to decrease an asset and increase an expense. Not too bad. So we're going to go over a few examples here. First off, we're going to deal with the supplies account. And for the supplies account, Sierra Corporation purchased supplies costing $2,500 on October 5th. And this is also shown up here. We would have it right here. There's our $2,500. Okay. And then all of a sudden at the end of the period, which happens to be only October, that the book is giving us the examples, that a physical count of the inventory at the close of business on October 31st reveals that 1,000 of supplies are still on hand. Okay, now when we look at on hand, first off, again, you have to understand that that really does mean they are physically still with us. We haven't used them yet. But when we look at this, we are talking about use of supplies. Basically, I mean, they're no longer with us. They've been done. They've probably been in trash now or shredded, depending on what it is. So this will decrease our supplies account. Again, we're only dealing with what we still have on hand. But again, we're going to take the 3 steps. First step is, what do we currently have in that supplies account? Well, we're showing that $2,500. So we do have currently $2,500. Next, again, step 2 in the 3-step process is what it should be. Well, for this one, we can see that our physical account says we only have $1,000 of supplies left, so it should be $1,000. So the last step is, how do we get there? Well, even though I'm showing you kind of right here, really the net change is taking the $2,500, what's originally in the account, and subtracted by our physical count. This shows that there was a 1,500 change, basically a decrease, to get to $1,000 in the balance. So we need to use what I call a sister account. And these sister accounts, again, is usually expense for an asset, is one that basically mimics their name. We just add expense at the end. So as you can see in the equation analysis right here, our assets, which is supplies, is decreasing. And then look at the account. All we did was add expense to supplies. And that one is also decreasing to show the usage of the supplies we did during the period. Okay. And then of course, here's an example. Here's what's showing on the table. So we have adjustment 1, A1, and it shows our supplies, and then we can see right here on the balance, it does match our physical account now. And then over here, we have our expense being adjusted, and then supplies expense here on the income statement column. Okay. Next, prepaid. Now, supplies is technically a prepaid. Again, we paid for a future benefit. Here, we're dealing with Sierra Corporation. They paid a $600 cash money for a 1-year fire insurance policy. Okay, coverage ends up beginning on October 1st. Now, again, their ending period is October 31st. So we know at least 1 month got used up. So first off, again, what's currently in our prepaid? Well, 600. Okay. Now, next, is us determining how much should be in prepaid insurance, or basically what expense do we have. So at the end of October, again, 1 month of this insurance has been used. So since this is for 1 year time frame, we take the time frame and divide it into the cost of that policy. So 600 divided by 12 months equals $50 per month. So 600 minus 50, our prepaid rent remaining, or prepaid insurance, I don't know why it's saying rent. Oops. Prepaid insurance remaining. I got it right here too. There we go. So our prepaid insurance remaining is $550. So which accounts is this going to affect? Well, it's going to affect, one, the prepaid insurance account. We're going to reduce it by $50 because we used up 50. And then we're going to use its sister account, insurance expense, and show an increase of this $50. So our equation analysis, again, the book wants to keep it the same to show that overall this side will decrease and assets will decrease. So prepaid insurance, insurance expense. And then right here is our adjustment number 2. Again, this already has adjustment number 1. So there's the 1,000 on supplies. Here's now our balance for prepaid insurance at $550, and then our expense being affected over here. Okay. Now, the last of this bunch is going to be usually the toughest to do, but we're going to keep it simple for this one. In fact, we're not even using the straight line method. Here, right now, your book is just going to give you the amount, and again, we're going to use it as prepaid. But this is called depreciation. Alright, so depreciation in itself is a process of allocating the cost of a fixed asset or plant asset or property, plant, and equipment, depending on how we call it in the business, over its useful life, or basically its period of service. So we get to allocate the cost, or basically the part that we end up using of that asset. So in that period that we've used the asset, during that time frame, we need to recognize the cost of the item. So this again is an allocation concept. It's not a value concept. And what we mean there is simply put this. This is not the value of the asset. Market value will basically be a different item or fair value. So those will be different. This is only showing basically what the book value is, or basically what we've allocated over the useful life of the asset. So this is going to bring in a brand new account. I mean, technically 2, but basically a new asset account called accumulated depreciation. Okay, and accumulated depreciation is going to be considered a contra asset account. Basically means that this account is designed to offset the balance of another account, namely the fixed asset account that we're using. Okay, because we're not allowed to actually directly change the cost of that fixed asset. It is what it is. So accumulated depreciation basically stores the depreciation over the useful life. So it just keeps building and building, and then once we remove, sell, or dispose of the asset, we can get rid of this account too, but it lets us know the value of the account during its life. It's basically a tracker. So for our example, again, I like these little pictures. They kind of show a little bit. We have Sarah Corporation, and assume that depreciation for the equipment is $480 a year. What will be the amount of depreciation recorded at the end of October? Okay. Now again, they started in October. We're just assuming that's for the whole month. But again, have we recorded anything for depreciation yet? Nope. So we have not recorded anything, so that means it's 0 as a current balance. So step 2, we need to figure out what the balance actually should be. And for this line, it already tells us $480 for a year is depreciation. So just like we did before, we're going to take that $480 and divide it by the time, 12 months. And again, we're only recorded for October, which is 1 month. So that means only $40 got used. So which accounts are affected? Well, we have accumulated depreciation equipment. That account will be changed by $40. An increase in depreciation expense for equipment will also be changed. Now, since this is a contra account, this is again offsetting or subtracting from another asset, namely equipment this time. So when we look at the equation, notice it is negative 40, basically showing it is decreasing by 40. Same over here for our depreciation expense. So overall, both sides lost $40 in value. And then we can see it right here on our table. Notice now the accounting equation for our assets. Accumulated depreciation is the only one that's naturally negative. Okay, so negative, negative, that's where we get the positive, but we keep down the sign. But it still works in the way that it works. Trust me, I can understand how confusing this can be at times, but just remember we do subtract out accumulated depreciation. So when we do this, we will need to show the offset on the balance sheet. Again, this is what is called book value. So these two will be together pretty much all the time. Now equipment was $5,000, and now we subtract out accumulated depreciation. Normally you'll probably see less than the accumulated depreciation dash whichever asset it is. Again, this happens to be equipment. And we come out to $4,960 now of book value. Again, different than the fair market value. Okay, it only shows the allocation. Alright, last little thing that we're going to go over in this video, because this was deferred expense, we're now going to do the deferred revenue. And deferred revenue, again, cash has been received in advance from performing services. So this means we're going to be definitely using unearned revenue. But during the period before it ended, we probably did some work for that person and thus earned a portion of that payment paid in advance. Again, if you want to think about this, think about again with singers, music artists. They have to perform concerts. Well, you get in by paying tickets. Well, if they haven't performed the concert yet, they have yet to earn that money because the concert hasn't been done yet. Or basically, they have a liability to pay you in case they cancel the concert. Well, when we look at this adjusting period. This is like saying, hey, this artist is going on tour. It's a 12-city tour, and all cities are now collecting money for this tour. And when we look at it, by the time the end of the year hits, this artist has completed 6 of their tours. Or basically, they completed half of the tour. Thus, did they earn half of their money? Yes. Okay. Now, if something happens and they have to cancel the other half, well, that other half still gets their money back. We still owe them that money. So again, some revenue has generated. For this, at the end, we're going to treat it like this. Notice, it's only affecting the liabilities plus equity side. We are not going to affect an asset with this. And basically, we're going to decrease unearned revenues, or basically our liability account, and increase revenue. Again, now it went from unearned to earned. So, for example, Sierra Corporation receives $1,200 on October 2nd from RKnox for guide services for multi-day trips expected to be completed by December 31st. From an evaluation of the services Sierra performed for Knox during October, the company determines that it should recognize $400 of the revenue in October. So, again, using the 3 steps. First off, the balance in unearned currently is $1,200. Again, this is to reflect our obligations to provide the service at a later time. Now, what should this be? Well, if we're saying 400 is basically occurred, well, we should recognize it. Well, 1,200 minus 400 means that our unearned balance should now be 800. Seems fair, right? I mean, have we still performed this job yet? No, we're in the process, but we have performed $400 worth. So, what accounts are affected? Well, of course, unearned revenue will have to basically decrease to show the reduced liability. And then service revenue will of course get the 400 boost to show the amount earned. So again, here's our accounting equation. So there's negative 400 unearned service revenue and 400 in service revenue. And of course, there's our balance sheet. Nice, pretty balance sheet that shows the decrease. And look, there's our balance that we figured out in step 2. Did work. And then here is our revenue that shows an increase. So we actually performed right now $10,400 worth of revenue in the month of October. Again, income statement because it's dealing with revenue account. So what we've got here, and this is where we're going to stop on this video, and I'll go over this in another video, is a concept check. So let's test your skills. We only have 4 transactions and a partial little little tablet. So it's not completely, they're not going to equal out. Sorry. But all I want you to do is an analysis of these 4 transactions. Basically, what kind of adjustments going on. And all you have to do is complete them. And of course, you need to put that explanation of where it falls in the income statement. And that'll be it for this section. I'll see you when I go over this concept check in just a sec.